All right, so let's talk about risk in futures. The risk in futures is actually the tick value times the number of contracts times the distance where your ticks are from where your stop is from your entry. Distance and ticks from where your stop is from your entry. So that's from a mathematical standpoint how we can determine the actual risk in a trade. All right, so some general guidelines as far as risk management. Number one, always use stops and always size your positions correctly. Now, one of the things I really like about the micro futures is you can enter a trade and take a very small position. Now, whenever you enter a trade, your objective on any trade entry is to get the best average price. All right, so best average price. Now, for any of you who've traded more than for a few days, you've probably had the experience you get into a trade and almost immediately the trade will move somewhat against your entry point. Rarely do any of us make the perfect entry into any trade. If people have figured that one out, let me know. But typically you're not going to make the perfect entry. But what you are trying to do with your trade entry is to get the best average price. Now, for people that are trading I'll say a smaller account, and if you're trading the stock index futures, traditionally people are probably trading 1 or 2 contracts at a time. If you are trading a small account and you're trading the E-mini or the NASDAQ futures, I will contend that you are more than likely, in a lot of cases, even over-leveraged in trading 1 contract. Now with the E-mini, the micro E-mini, the MES is a symbol, you're taking on 1/10 the risk per contract. However, you might think that, okay, I'm not going to make a lot of money trading 1 contract. Well, you don't have to just trade 1 contract, but what I am saying is you can start out and enter your trade with just maybe 1 or 2 contracts, take a very small position. If the trade's working for you, you can add to the position. If the trade's not working for you, you can then exit the trade with a very small loss. All right, so some things I'll mention about your risk management. If you're trading a small account, let's just say, for example, a $2,000 account, just keep in mind the $2,000 account, you still only have about $1,500 of available margin. Okay. So again, as I said, if you're trading the E-mini, crude oil, NASDAQ with a smaller account, most likely you are over leveraged.